Good afternoon and welcome to today's Income Tax Update webinar. This webinar is part of our Learn at Lunch series, and it's possible thanks to support from the Farm Service Agency. To find additional information on today's topic and other farm management topics, please visit our eFarm Management website. I will put this link in the chat box in the lower right corner. If you have any questions, please write them down in the chat box and JC will answer them at the beginning of the presentation. Now, I'll turn it over to today's speaker, JC Hobbs.
Thanks, Brent. Everybody hear me, I assume. Today's discussion will be income tax, providing an update of where we're at, what possibilities or what's going to be changing, and then also some discussion upon what's being proposed for the future. Right now, if you look at where we're at, the topics of today, we're going to look at the enacted changes for the coming years from the PATH Act that was enacted in 2015. We'll look at some of the proposed changes from the President and also the House Ways and Means Committee to get an idea of what's going on. Now, you'll notice at the bottom of the screen, there's a website. The Ways and Means at the House has a website that has what they call the blueprint, the tax reform blueprint. It gives an idea and some discussion of all the things that's being proposed at the current time in terms of legislation. So it's a good source of information, fairly easy to understand and kind of get an idea of what's going on. The first thing that's being brought up as changes. Now, like we said, we're going to talk about things that are happened with the 2015 Act and what we're going to look at for the coming years. The only depreciation we're allowed is on business use portion of an asset. So if an asset is used 50% for business and 50% for non-business use, we only depreciate that 50% that applies to the business side of it. It can be less than that, but again, only the business portion is allowed depreciation. The business use has to be greater than 50% in order to use the 179 expensing election. What this allows is to write off the amount of the expensed item in the year that it's purchased, and we'll give you in a moment what those limits are for the current and coming years. But it has to be more than 50% used in the business and to allow the 179 rules at the present time. Now, when an asset is sold, if it's been depreciated, now the IRS rules say allowed or allowable. So even if a farmer or another businessman does not depreciate it, it is assumed it has been. And when you sell the asset, what would have been allowed as depreciation is recaptured as ordinary income in the year of sale. It does not get capital gain treatment, it's ordinary income. Capital gain only applies to the amount above its purchase price when it's sold. So, in other words, you buy an asset for $100,000, depreciate it down to zero, you sell it for $150,000, you have $50,000 of capital gain income. It's taxed at a preferable tax rate. When an asset is traded, what happens here? The depreciation from the old asset, well, it adjusts the basis of the new asset in the year of exchange. If the new asset basis was less, then we have depreciation recapture. Otherwise, we depreciate the difference in the coming years. The PATH Act, basically, here's the changes that we're going to be looking at for 2017. So we just talked about the rules as they apply. Now for 2017, here's will be coming up. If you look at changes in the first year depreciation, it's also known as a bonus depreciation, and we'll also be looking at the 179 expensing rules. So the first year or bonus depreciation for 2017, it's the same as it was last year. 50% depreciation first year is allowed for qualifying property. Has to be new, never used by anyone else, and placed in service before January 1 of 2018. It applies to the majority of assets used in agriculture. I've not been able to find any that it does not apply to. The percentage allowed will be reduced for 2018 and 2019 unless Congress enacts something different. So right now, 2017, 50%. 2018, 40%. It's only 40% of the items cost. For 2019, it drops to 30%. And for 2020 and beyond, additional first-year depreciation goes away. Now, the purpose for this originally was to bring about stimulation of the economy through the purchase of depreciable assets by businesses to stimulate growth. And I guess for the time, it's changed. It was 100%. Now it's going to go away in 2020. Let's look at an example. So we buy a new piece of equipment, new tractor, 2017 for $100,000. Farmer elects to use a 50% bonus in that first year. So he deducts $50,000 of bonus depreciation. Then he takes the remaining $50,000 and is allowed depreciation on that. So he gets a total of $55,355 of depreciation in 2017. So bonus depreciation is a major impact on the amount of depreciation that's allowed. Now the 179 rules. These apply to assets that are depreciable, new or used. Bonus depreciation has to be new. 179, new or used, doesn't matter. For 2016, the limit was $500,000. We're putting this in there to kind of give you an idea of what you're looking at for changes in the future. For 2017, the limit went up, or the amount that's allowed went up $10,000. And the investment limit also went up. The investment limit, $2,030,000. 2018 and beyond, well, the indexing of those both numbers, the beginning or the amount that's allowed and the investment limit, are both indexed for inflation. The inflation amount has to bump those numbers by a minimum of 10% or $10,000 before it adjusts or changes. Last year we had a major amount of change, inflation, so we ended up allowing the investment limit to go up $20,000. Normally it wouldn't go up that much, but it did happen. So you'll have to watch these numbers each year. There's a chance that the investment limit will increase, a chance that the amount allowable will increase. Now, what is qualifying property that we're looking at here? Well, tax terms, it's tangible personal property. In other words, you can get a hold of it and put your hands on it. From farming, we're looking at machinery, equipment, purchased breeding livestock, business vehicles, etc. Has to be an integral part of the business, farm business. They call it production agriculture. Can be a storage facility, a single purpose ag structure. It just cannot be a barn or a multi-purpose storage facility. Those will not be allowed. Now, qualifying property, like I said, can be new or used. More than 50% in the use of an active farming operation, or if you have a material participating landlord. That's, in other words, they are participating in the farm business. Typically, this requires a sharecrop landlord that is actively involved in managing along with the tenant. If it's strictly a sharecrop landlord and there's no material participation, all they get is their crop, they sell it, they do not qualify as being able to use the 179. It cannot create a loss. So if we have $100,000 of net farm income and we have the ability to write off up to $100,000 of Section 179 property, if we bought more than that, well, we can't use it unless we have W-2 wages, off-farm income. That can be used to offset the remaining amount that was not allowed because of our income from farming limitation. So it's W-2 wages. So a husband or wife working off the farm, getting a W-2, that amount can then be used to reduce the amount of the 179 that would have been postponed until next year. It's not lost, it's just postponed. The 179, basically it reduces both income tax and self-employment tax liabilities. So you've kind of got to watch it. If you're looking at trying to build up quarters of coverage for retirement, disability, etc., you really want to watch how hard you use or apply the 179 rules and allowances, because it will reduce self-employment tax, and that does have an impact in later years, especially when you're looking at retirement. So how does this apply? Well, in this example, we've got a custom harvester. He buys several new combines. He spends $2,050,000. So the investment limit is going to be exceeded by $20,000. So then he has to reduce his amount of $179 that's allowed by $20,000 as well. So basically, you take the $510,000 that would be allowed. Since he's over the investment limit, it reduces the allowable amount dollar for dollar. So the amount that he can write off now is going to be $490,000. Basically, the 510 less the 20 that is over the investment limit. So consequently, you kind of got to watch that amount to see where it goes. In this example, if we had used the bonus depreciation and done some other manipulations, we could have probably got the full amount of this, but you're still going to reduce the overall limitation or overall depreciation amount that's allowed in the first year either way. Now there's some proposed provisions. These are subject to change depending upon who or what happens. Right now they were talking about having these in place or discussed this year. So far I've not heard anything to say that they're going to be. It looks like we're going to be still hashing out the Health Care Act. That will be done first, and then we'll probably get into tax law changes. But right now, if you look at what's being proposed, they apply to both business and individual. There's some estate tax implications. There's some gift tax implications. And we're going to go through these. If you look at the individual items that's being proposed, right now what's being talked about are changes in the tax rates. We're going from a much wider base to a much narrower base, as the president would like to. He's proposing, and we'll look at these in a moment, reduced number of tax brackets, eliminating most of the itemized deductions, looking at simplifying the higher education tax benefits, repealing special interest provisions, for example, the mortgage deduction on the second home, and also eliminating the alternative minimum tax. So these are the things that's being proposed right now. Now let's look at these. If you look at our current, and this is on the left-hand side, our current tax rates, you'll notice we've got 7 of these, ranging from 10 to 39.6. Capital gains rates that apply, if you're in a 10 or 15% bracket, capital gains are not taxed. If you're in the 25 through 35% brackets, capital gains are taxed at 15%. If you're in the upper tax bracket, it's taxed at 20%. Remember what I said earlier, capital gains get a preferential tax treatment. This is why. Tax brackets on that's 0, 15, and 20, where the others run from 10 to 39.6. Now, qualified dividends, if it's also get the same capital gains treatment if it's a domestic or qualified foreign corporation. Now here's what's being proposed. If you look at what the ordinary tax rates would be, Trump's saying 15, 25, and 35. So we get rid of the 10%, we get rid of the 39.6, and we kind of work something out in the middle. The Ways and Means blueprint, they're looking at a 0%, 12% being the bottom. The reason that's kind of fuzzy in this example is you've got to look at the standard deduction of where it applies. Standard deduction would double or almost double. So therefore you lower the amount or increase the number of individuals that would not pay any taxes whatsoever. That's why if you look at this thing, that bottom end really represents about a 0 to 12% depending upon where you're at in terms of your taxable income after we double the standard deduction. So married filing joint would go to $24,000, single others would be $12,000. So basically by that you get a major jump. It increases those numbers to where it does away with the 10% bracket. Now we're looking at an increase in the child independent tax credit as well, and then only deductions that's going to be allowed are charitable donations and mortgage interest payments on a first home. All the others are going to disappear. You're looking at income from interest, dividends, and net capital gains. 50% of that will not be taxed. So this is what is being proposed from the individual side. Now let's bounce over to some of the business items. Small businesses. We're going to take the tax rates that apply there. We're going to give a little bit of a reduction. The business and pass-through entities, so individual, sole proprietors, partnerships, etc., sub-S corporations, anything that's taxed back to the individual, we're going to look at a maximum base on the 25% bracket. The 33% bracket will not apply to the business owner in those as well. So they're going to get, again, a tax break to the business side or business income. Corporations, looking at a flat tax rate of 20% for the small business to a maximum of 25% bracket. The double taxation bite reduces that 50% of capital gains and dividends being taxed. So we're seeing a major discussion here of changes in the corporate tax. So hopefully the discussion is here to eliminate or definitely reduce the desired movement of corporations out of the U.S. into foreign countries. Other business items. Immediate write-off of depreciable assets. In other words, what they're going to do away with are the depreciation schedules. So essentially what will come of this is every business that buys an asset will essentially be able to write off the year that's purchased, all the cost, no matter what. Doesn't apply to land. So it's only depreciable assets as we currently understand them. Immediate write-off. Now the next fun piece is what you're looking at on the interest expenses. They're talking about doing away with net interest. So in other words, what that means is, as long as I have business interest expense, I have to have other interest income in order to deduct any of those expenses, interest expense. Anything that I do not have interest income, the interest expense goes away. This is going to have, or would have, if passed, will have a major impact on agriculture because what do? Most of our investment applies to interest. We borrow money to buy it. If they do away with this, we've got to have interest income to be able to offset any of that business interest expense. So from agriculture's point of view, and from what Farm Bureau and others are proposing to Congress to say this is not a good deal, we'll have to see what happens. But that is the proposal right now. The next major thing that happens in agriculture is we do suffer from the impact of prices, weather, all kinds of issues or problems that create operating losses from during the life cycle of the farm. History has allowed us always to carry those net operating losses back. Current law allows us to carry them back 5 years, offset income from those prior years, and get a tax refund to help with the cash flow issue. Proposal is net operating losses now only allowed to be carried forward. Now under current law, carry forward the last 20 years. Proposal is there's no time limit to how many years we can carry this forward. But the annual amount that we can carry forward will be limited to 90% of the taxable income, net taxable income for that year. So, again, a major shift. Probably going to have some major impact, again, from the standpoint of cash flow, because we've always been able to carry it back. Get some relief from the standpoint of a tax refund. Without that, we don't have to wait until future years to get any income tax benefit. There's some discussion here on the pros and cons. This is going to be an interesting one to see what happens. So basically what we're looking at is an overall move towards cash flow taxes. They're referring to this as a cash flow tax approach. One of the things that's being proposed due to the change in the corporate tax brackets is the value-added tax adjustments and the border-adjusted tax for our foreign trading partners. Now there's some discussion on this, and I didn't put the website, so I'm going to I'll give it to you now, and you can write this down. I'll also mention it again later. The Tax Foundation, taxfoundation.org, has a pretty extensive coverage on the border adjusted tax. There's some discussion there. It looks like it's going to be, in their point, leveling the playing field. If you look at really what it's talking about, the border adjusted tax is a destination tax, destination-based tax. In other words, it's tax to the consumer. We'll be taxing imports, U.S. exports, our companies sending goods out, those items being tax exempt. So exempting exports, taxing imports. If you look at what it's trying to accomplish, it's trying not to interrupt or impact domestic consumption. The big problems will be, one, and this is what we got to watch out for. If you look at what most economists are saying, they're saying that the value of the dollar to other currencies shouldn't have an impact. However, I'm not so sure about that. If we look at whenever we start looking at our trading partners, how will they react to this? Here's the big question. The World Trade Organization. How will they view this? Even though we're looking at simplifying our international tax rules, the World Trade Organization may have a different impact or different expectation based upon their idea of not a level trading field with our foreign trade partners. So, have to watch this. More to come out right now. The best place for information is the taxfoundation.org website. They've got a good extensive discussion of what we can possibly expect from this. There's been some discussion on Congress. Don't know exactly where we're going or how this will be approached or even put into play. This is just a proposal. The estate and gift tax, another area you've seen a lot in discussion. The estate tax to be eliminated. Will it happen? What happens if it does? Well, to give you a little background and a little of a side note, currently our estate tax, the federal estate tax, if you look at year in, year out revenues and the cost of administering it, it appears that there's very little economic impact or tax impact once we deduct all the costs of implementation of having it. Therefore, there's a lot of discussion that it's probably going to be eliminated from the standpoint just of it's a cost-reducing factor from administration. Will that happen? Don't know. What we really don't know is the next bullet down. Unknown issue is handling of the basis of the transferred assets. What does this mean? When a person passes, his estate gets a step up in basis, fair market value, date of death. Whoever receives that, the heirs or beneficiaries, get to carry that forward. So here's how this thing works. Dad passes away. Farmland has been in the family for several decades. Let's say it was bought for $100 an acre and currently could be sold for about $2,000. That $1,900 gets stepped up. That's part of the estate tax piece. Most estates are not taxed under current legislation because the tax rate applies at $5,450,000 of assets, valuation. Most of our farm operations don't hit that, so therefore, what the next generation receives is farmland worth $2,000. If they immediately sell it, there's no tax implications if they sell it for the $2,000. So it has a major impact to the heirs when they receive it as to how much tax they have against it or have to pay when they sell it. The other side of the coin was looking at the carryover basis. Carryover basis, if you remember the 2010 rules, they said if you gave something to your heirs, the basis that was in the hand of the decedent is in the hands of the new receiver. So let's lose that prior example. Farmland was worth $1,000 when we bought it, or $100 when we bought it. Currently worth $2,000, but we do not get to use that. It goes to the heirs at $100. They sell it. They pay the tax. These 2 points have not been addressed in the discussion of the estate tax elimination. These are going to be major components to see what happens. If we do get to carry it over or have the step up in basis, fair market value, it'll be a great item. If If we do away with the estate tax and we continue to carry over basis without a major change, and I mean major change in the capital gains rates, this thing is going to be a boondoggle. This is one of those, I'm still waiting to find out what's going to happen. As soon as I know, I'll probably be putting out some more information. But right now, we do not know. It hasn't been addressed. Nobody's been talking about it. It will be interesting to see what takes place. The gift tax, it has also not been addressed. Same thing with the basis of the assets. So if they do away with the estate tax, will we do away with the gift tax? Probably not. But we'll still have the issue of what will be the basis as they apply. Currently, it's carryover basis from the giver. So more than likely, it's not going to be an issue. But right now, again, it hasn't been addressed either. Now, when we talk about simplification, this is on the House Ways and Means website. And it's rather unique in this. If you look at all the proposed changes by Congress, by the President, all the pieces, this would basically be how the tax return would be applied. You look at your wage and compensation income. Half of your investment income is going to be taxed. Not all, just half. If you contribute to specific savings plans, IRAs, etc., you're going to take that off. You take off your standard deduction or home mortgage interest, any charitable contributions that you're allowed. That gives you your taxable income. The credits you're allowed will be the child tax credit, the earned income tax credit for low-wage households, and the higher education credit. Once you take those three off of there, then your total tax. Any taxes withheld is in your amount due. Talk about interesting simplification. Will this happen? Don't know. Would it be nice? I'll leave this up to you. Looks to me like simplification could happen, or could be a benefit. This next slide looks at marginal tax rates over time. Now, our current tax code started in 2013, and you can kind of see as high as they've gotten. 93% was our highest tax bracket, and that was in the 60s, late 50s, early 60s. Some of you may remember the tax brackets being in the 70%. I do. That changed with the election of 1983. And since then, we've been hammering things down, and we've pretty much kept them below the 40% rate. But you'll notice on the bottom side, there's been years where we had a 0% tax bracket. So that's not uncommon either. This kind of gives you an idea of how the disparities of our tax code has gone over the years, to kind of give you an idea of what the extremes have been and where our simplification may be headed. So those pretty much cover the major things that I'm seeing at the present time. There's still been a lot of discussion, but nothing has been written down. Nothing has been where we say, yes, we've been talking about it, analyzing it. If you have questions, feel free to type them in. Also, here's the survey link. We want to know what you thought of the material. If you have additional thoughts, ideas, send them on that survey as well. We'd like to know what you thought, what you think, and we definitely appreciate you taking the time to fill that out. So without any further questions, or not seeing anything, I'm going to turn this over to Brent, and we'll continue on. So, have questions? Continue to type. We'll be around for a minute. Thanks, Brent.
You're welcome, JC. Thank you. So, if there aren't any other questions, I do want to remind everyone that our next webinar will be on July 25th and cover marketing opportunities through the Oklahoma Quality Beef Network. I want to thank everyone for viewing today's webinars, and have a good afternoon. Thank you. Thank you.